All right, we are in the second video for chapter 11, the last chapter of Intermediate Accounting 1. Of course, you want to stay tuned for all the videos for Intermediate 2 so that we can work through those together as well. But let's go ahead and start talking about dispositions when it comes to property, plant, and equipment. So this is where we are getting rid of an asset that we have already used throughout its service life, or we are getting rid of it sooner than we thought possibly. It may be that we are selling the item and we are going to make some money from it, or it may be that we are just going to dispose of it completely because it is no longer worth anything. So during a disposition of an asset, we want to make sure we get everything off the books that has anything to do with that asset. So we want to remove the asset's original cost. So maybe it says equipment and it was $400,000. We've got to get that off the books because it's not ours anymore. We also, of course, have to remove the accumulated depreciation, that contra asset that goes along with the asset. So we are going to need to debit that to get it off the books. We also need to record any cash proceeds. So if we are selling it to someone else, whether there's a gain or a loss, we still need to record that cash coming in. Now, when should we recognize a gain or a loss is the next big question. So if the proceeds, if that cash we get is more than the book value, there's going to be a gain. Minus book value. If it's a positive number, it's a gain. If it's a negative number, if the proceeds are less than the book value, it's a loss. Now, what is book value? This is super important. We have talked about this before, but it's very important, not just in this chapter, but in all of accounting, to understand what makes up the book value. So remember, that's the original cost, the capitalized cost on the balance sheet, minus accumulated depreciation. That gives you the book value. Very important to know that because you're going to be expected to understand that going forward. So let's look at an example. It is January 1st, 2025. Dirt Rich Industries purchased a machine for $275,000. The company expects the service life of the machine to be 5 years with an estimated residual value of $25,000. So they think it's still going to be worth $25,000 at the end. Dirt Rich Industries uses straight line depreciation. Suppose that Dirt Rich Industries decides not to hold the machine for the full 5 years, and instead they sell it December 31st, 2027. So that's 3 full years that they held it. How convenient that they bought it on January 1st and they sold it on December 31st. That makes it nice and easy for us. So they sell it for $140,000. Before recording the sale, now this is super important, before they record this, they have to update their depreciation to the date of the sale. Since depreciation was recorded for 2025 and 2026, then we just need to record it for 2027. If it was a half of a year and they say, oh, we record depreciation on the last day of the year and here it is June 30th and we're selling it, then we would need to update half of the depreciation. But that's the first step. Now, this question makes it pretty clear so that you don't forget. But it is very likely that you'll see a problem that doesn't remind you that you need to record depreciation. So you just need to make sure that you read through it and understand whether or not depreciation was recorded up to that date. So first step, we record depreciation. How do we calculate that? We take the $275,000 minus the $25,000 of residual value. That gives us $250,000. We divide that by 5 years. That's straight line method, and we get $50,000. So for 2027, we are going to debit depreciation expense for the $50,000 and credit accumulated depreciation. That's the same entry that would have been made all 3 years. So now we've got it up to date. 2025, we had accumulated depreciation of $50,000, 26, and now 27. So in the accumulated depreciation account, we have $150,000 sitting there. So our journal entry is going to come up after we calculate whether there's a gain or a loss. So the cash proceeds for this asset was $140,000. Hint, hint, you're going to need to record the cash coming in. Anytime there's cash, it should be pretty easy to know we debit it if it's coming in, credit if it's going out. So then we have to figure out what the book value is to see if there was a gain or a loss. So we take the original cost, the $275,000, minus that accumulated depreciation we just saw on the last slide, And now we have a book value of $125,000. So we take the cash proceeds, the 140, minus the book value of 125. We end up with a positive 15,000, which means there's a gain. So when we make our journal entry, we are going to be debiting cash because we got cash of 140,000 coming in. We're going to debit accumulated depreciation because that is a contra asset. It has a normal credit balance. We got to get it off the books. So we're going to do the opposite and debit it for the total of 150,000 that we saw on the last slide. We got to get the equipment off the books. It was originally 275,000. Let's credit that asset. It is no longer ours. And the difference here is that gain of 15,000 that we'll be crediting. Now, if you didn't take the time to do that top calculation and you just went straight for the journal entry and you're like, I'll just fill in the debit or credit wherever it's missing, how do you know whether or not it's a gain or a loss? Just remember, we always credit gains just like you credit revenue. And we always debit losses just like you debit expenses. So that should help you out when it comes to this part. Jump into assets that are held for sale. And we're going to focus on those because they can be treated differently on the balance sheet than those that are just still in use. So under IFRS, the International Financial Reporting Standards, very similar to the way that generally accepted accounting principles would show this, an asset or disposal group can be classified as held for sale only if all 6 of these criteria are met. So one, management commitment. So commitment to that is that they are going to be selling this. They're saying, yes, I am planning to sell this. We're not planning to change our mind. Available for immediate sale. We don't have to do anything. There's no big renovations or anything that we have to do before we sell this asset. Active marketing. We are really looking for a buyer for this. We're not just saying it's held for sale. We are actively trying to find someone to purchase it. Probable sell. So we've got it listed at an amount that we think will realistically be able to sell this asset for. Unlikely to change. They're not wishy-washy going back and forth. It is very clear that, again, management has committed to sell this, and we do not expect for them to change their minds on that. And then that will be likely to actually find a buyer. This is not an asset that was specifically made for our company, and realistically, no one else will ever buy it, but we are likely going to be able to find that buyer. So an asset that meets all 6 of these criteria is classified as held for sale and is reported at lower of its current book value or its fair market value less any cost to sell. So that's the big difference here. We can either show it at the book value, or if it's less, as long as it meets these 6 criteria, we can show it at the fair value minus any cost to sell. So let's look at group and composite depreciation methods. So these depreciate assets collectively rather than individually to reduce record-keeping costs. So let's say Amazon bought a whole fleet of 50 trucks all at once. And they said, okay, we don't want to go in and have to keep track of all 50 of these individually for depreciation. Instead, we're going to use the group depreciation method. This is where a group of depreciable assets share similar service lives and other attributes. So we will just group those together and depreciate them as a whole. Or we can use the composite depreciation method. This is where the group of depreciable assets do not have physical similarities, but they can be combined anyway to gain that convenience of a collective depreciation calculation. So it doesn't all have to be the same asset, but they at least are similar enough that we can put that into one group and we are able to depreciate those collectively. So let's look at an example for Dirt Rich Industries. So they began operations of their new division in 2024. It will depreciate its fleet of delivery trucks using the group depreciation method. The cost of trucks purchased early in 2024, along with their residual values, estimated lives, and straight line depreciation are going to be listed here based on that type of truck. So we have 3 different classifications of these trucks: heavy duty trucks, light duty trucks, and medium duty trucks. We see the cost of each one listed, then we see their residual value, and then the difference, which is their depreciable base. So for the heavy duty trucks, costs a total of $500,000. The total residual value is 50,000, so their base is going to be 450. That's how much we actually need to depreciate. Then it shows the estimated service life in years, and that's how much we divide the depreciable base by to get to the annual depreciation. So we see the heavy duty trucks, we took the 450,000 divided by 10 years, and we have 45,000 in depreciation each year. So that is going to be our group. But we can actually bring all of these together and depreciate them all collectively if we would like. So our total annual depreciation is 112,500. So if we want to do the group depreciation rate for all of these, we take that annual depreciation divided by the cost of all of those assets together, and it tells us the rate we're depreciating them at, which is 11% in this case. The average service life is the next thing we want to know, and we're going to take the 900,000, which is the depreciable base, divided by the annual depreciation, and that shows us that it's 8 years as the average service life. And we can kind of spot check that by looking at the estimated life, and yep, 8 years would look right since we have 6, 8, and 10 years that we're averaging out there. So that's how we would figure out those numbers. All right, let's jump into natural resources, because natural resources, they also are going to get used up over time, but we don't call this depreciation, we call it depletion. And that is because we are depleting the earth of a natural resource in order to turn it into inventory. So our asset is the natural resource, and then it is changed into inventory as we deplete the earth of that resource. So we're going to use activity-based units of production. That is primarily what is used for natural resources when it comes to depletion. Makes a lot of sense. If we have a piece of land that has a whole forest and they purchase it and they say, okay, we are going to cut down all the trees and then it's going to be turned into lumber. There, it's going to be turned into inventory. We depleted the earth of those trees, and we are going to show depletion, which is like an expense, the same way we'd show units of production for depreciation. So let's look at how we calculate that. The depletion base is the cost minus residual value, which is going to be that numerator. Then we want to find the depletion per unit. So we take the cost minus the residual value divided by the expected extractable units. So how many units will we expect to be able to take from that forest? How many trees? How many tons of coal? How many tons of ore? We're going to look at that and how much will we have total, and that will tell us what we are going to be depleting it by based on each year and how much we actually extract from the earth. Then once we get the number, we will calculate that rate times the actual units that are extracted, and that will be our depreciation. What, I'm like making up new things here. There's too many words. This will be our depletion for that accounting period. Then notice we are crediting the actual natural resource, not accumulated depletion, but the natural resource itself. So let's look at Dirt-Rich Industries. They purchased a tract of land with 500,000 tons of ore that's expected to be extracted. They purchased it for $3 million. The company estimates that the land will have residual value of $500,000. In 2025, the company mined 60,000 tons of ore and sold 50,000 tons. So let's pull out the important information. We have the tract of land. It cost $3 million, and the residual value is $500,000. So our depletion base is the difference, which is $2.5 million. That's how much total we're going to deplete it by. Then we take our depletion per unit. We get that from taking the 2.5 million, divide it by the number of tons that it tells us right there in that first sentence that we're expecting to be able to get of ore from this piece of land. So then that gives us $5 per ton. So then at the end of the first year, the end of each year, they take $5 per ton times the number of tons that they were able to extract, and that's how much they are going to debit depletion for. So we take the $5 per ton, we multiply it times the 60,000 tons, because 60,000 is how much they actually mined. The 50,000 tons that they sold, that's just there to throw us off, because while that's important and we want to sell lots of it, that has nothing to do with our depletion. So we are taking the $5 per ton times the 60 tons, and that gives us 300,000. We debit depletion, which is an expense account, and then we credit the land, the natural resource itself. So then part of this, they also purchased a piece of excavation equipment for $500,000 for this project. The equipment will be sold for an expected salvage value of $50,000. So we are going to take into consideration whether or not we need to keep this separate and depreciate it. So here's what we need to think about. If an asset is movable and usable on future projects, then the asset's depreciable base should be allocated over its useful life. If the asset is not movable, the asset should be depreciated over the useful life of the natural resource, whichever is shorter. So for this case, they are only going to be using this for that one project. So we are going to take the $500,000 they paid for it minus the salvage value, and we're going to divide it by not the number of years they're going to use it, but by the number of tons that they expect to get from that natural resource. That gives them 90 cents per ton. And since they excavated 60,000 tons in that first year, we take 90 cents times the 60,000 tons, and we saw that in the last slide, and that gives us 54,000. We would be debiting depreciation expense, crediting the accumulated depreciation for this piece of equipment. Well, let's keep the fun going. We're going to move on to intangible assets. So with an intangible asset, just like we saw with property, plant, and equipment, the useful life is going to be the projected amount of service the asset will provide. With intangible assets, though, a lot of times there are legal permissions that we have to take into consideration. So most of our intangible assets are going to have some kind of legal specifics that we need to look at. The residual value, a lot of times there's not residual value with intangible assets, but we still need to look out for it in all of our problems. But that's, of course, the expected value after its service life to us. And then the allocation method, we are going to choose whatever reflects the pattern that shows the same as the generating benefits to the company. Typically, we're just going to be using straight line depreciation or amortization with intangible assets as well. So let's look at Dirt Rich Industries. So early in January, the company purchased the following two intangible assets. They have mineral rights license for $300,000. The license agreement is for the period of 15 years. It doesn't say anything about it won't bring us value for that long. So we're going to take that $300,000 divided by 15 years because we're going to use the straight line amortization method. Then a proprietary soil treatment patent for $90,000. The remaining legal life of the patent is 12 years. However, due to anticipated environmental regulation changes, the company estimates its useful life is only for 7 years. So in that case, even though its legal life is for 12 years, if the company can only get 7 years of life out of it, that's the service life that we're going to amortize it over. And anytime I say amortization, I'm just talking about whenever we are expensing out the cost of that asset, the depreciable base for an intangible asset. So it's the same thing as depreciation, except depreciation is specific to property, plant, and equipment. Amortization is specific to intangible assets, and depletion is specific to natural resources. So we take that $300,000 for the license, divide it by 15 years. We are debiting amortization expense for the $20,000 for straight line amortization. And then we credit the actual intangible asset. In this case, it is a license that we're going to be crediting, or it could be a franchise in some situations. We're going to credit that actual asset. There's no accumulated amortization. That's only for depreciation. Then for the patent, we are going to debit the amortization expense for $12,857. That's taking that $90,000 we paid for it, divided by the useful life that we're predicting of 7 years, and then we credit the actual patent itself. There's also software development amortization. Now, this is an intangible asset. Software development can bring us value, and Dirt Rich Industries develops custom financial analysis software for sale. The new development project started in 2024 and reached the point of technological feasibility on July 15th, 2025. So with software development, as they are developing it, we are going to treat those costs one way, and then we're going to treat the cost of the point of technological feasibility to the point of us being able to sell it to customers a different way. And then the software was available for sale and has the following related sales information. So then we're going to treat that after it's sold a different way. So stick with me here. So prior to technological feasibility, they incurred $1,450,000. And I would highly recommend, here, let me put it all up there for you. I would highly recommend you screenshot this because we're going to be referencing back to it, or take a picture of it or whatever. So they will expense out all of those costs, that 1.45 million, while they are developing it. But then once it reaches the technological feasibility, they will capitalize the cost. The $950,000 from the technological feasibility date to the date that they start selling it, they will capitalize that. They'll put it on the balance sheet and be able to amortize that. Then we're going to look at how these cells will be treated. So we have cells for 4 years from 2026 to 2029 that came from a benefit of the software development. So let's look at the two different ways that we can amortize software development. We have straight line. We would take that $950,000, the cost from the technological feasibility date of July 15th, I think it was, until the end of the year, which then was when they started selling the software. We divide it by the 4 years that it is going to be bringing us benefit, so they'd be amortizing it of $237,500. Now, if we looked at our revenue for those 4 years and we did a percentage of revenue method, we would switch things up a little bit. We're going to take the 4.2 million of revenue for 2026, that first year of sales, divided by the total amount of estimated revenue, the 14 million, again, reference back to that last slide. That gives us 30%. The 30% is what we would multiply times the capitalizable amount. So that would be for 2026. 30% of our sales for those 4 years are expected to be in 2026. That gives us $285,000. So these are the two options. We are going to go with whichever is greater, whichever is a larger amount. Since the percentage of revenue is used, is going to be used since it produces a larger amortization amount. So then we would be debiting amortization expense for the $285,000, and we would credit the software development cost. Because it's an intangible asset, we credit that actual asset itself. So you might want to watch that part again because that's very different and quite confusing when it comes to software development cost. Our final slide of this video, but we still have more to come in this chapter, not quite done yet. All right, we got little Timmy here. Are there any intangible assets that aren't subject to amortization? Yes, actually. So we have assets that have indefinite useful lives, like goodwill, trademarks, and trade names, that we would not amortize. And there may be also some other ones like this, even copyrights, sometimes we do not amortize. So if they have an indefinite useful life, and that's included always with goodwill, we will not amortize those. You are going to see in the next video where we start testing for impairment for things like goodwill.